Have you ever wondered why stock market crashes happen? It's a question that rings in the minds of many, from seasoned investors to curious bystanders. The stock market, with its unpredictable rises and falls, seems to have an uncanny knack for crashing. But why is this? What causes these financial earthquakes? This video aims to shed light on these queries, taking you through a historical tour of the most significant stock market crashes. So, buckle up and join us as we journey through the highs and lows of the financial world. Our journey begins in the early 18th century with the South Sea Bubble. The South Sea Company, a British joint stock company, was the central player in this dramatic financial saga. The company was granted a monopoly to trade in the South Seas, a region of the Pacific Ocean, and its stock became the darling of investors who were seduced by tales of unimaginable wealth from trade with Spanish colonies. In the year 1720, a wave of speculative frenzy swept through Britain. Investors from all walks of life, aristocrats and commoners alike, were pouring their life savings into South Sea Company stock. The company's share price skyrocketed, fueled by rumors, speculation, and the illusion of guaranteed profits. This speculative bubble, however, was not built on solid foundations. The South Sea Company's trade with the Spanish colonies was minimal, and the promised riches were largely illusory. Worse still, the company's directors were engaged in fraudulent activities, secretly selling their shares while publicly promoting the stock. This manipulation created an artificial demand, inflating the stock's value to unsustainable levels. When the truth about the company's precarious financial situation emerged, panic ensued. The bubble burst, and the stock price tumbled down as quickly as it had risen. Investors who had once dreamed of immense wealth found themselves facing financial ruin. The crash led to a severe economic depression, and its impact was felt not only by the unlucky investors, but by the entire British economy. The fallout from the South Sea Bubble was significant. It led to a public outcry, investigations, and the implementation of new financial regulations. But perhaps the most lasting legacy of the South Sea Bubble is the lesson it provides on the dangers of speculation and financial fraud. This crash served as a stark reminder of the dangers of speculation and financial fraud. It illustrates the devastating consequences that can occur when unchecked greed and deception rule the market. The South Sea Bubble was not the first financial bubble, and as we'll see, it was certainly not the last. Fast forward to the 20th century, to the crash that led to the Great Depression. In the Roaring '20s, America was booming, industries were growing, and the stock market seemed to be on an unstoppable upward trajectory. But beneath this veneer of prosperity, there were warning signs of an impending disaster. Overproduction was rampant, with factories churning out goods faster than consumers could buy them. This led to a surplus of goods, which eventually resulted in falling prices and profits. At the same time, Americans were amassing high levels of consumer debt. Encouraged by easy access to credit, people were buying cars, appliances, and houses, often on installment plans that they could ill afford. This debt-fueled consumption was unsustainable, and when the bubble burst, it left many Americans unable to pay their bills. On top of this, the stock market itself was a house of cards. Speculative investments were the order of the day, with people buying stocks on margin, essentially borrowing money to buy more stocks. This worked great as long as stock prices kept rising, but when they started to fall, it triggered a vicious cycle of selling, which only drove prices down further. The stock market crash of October 1929 was the culmination of these factors. Over a period of just a few days, the market lost a significant chunk of its value. This was the beginning of a downward spiral that would last for more than a decade, leading to widespread unemployment, poverty, and despair. But it wasn't just the financial sector that was affected. The Great Depression had far-reaching impacts on all aspects of society. It led to major changes in government policy and public attitudes towards finance and the economy. It also sparked a wave of social and political change, as people sought to find solutions to the economic crisis. The Great Depression was a harsh lesson about the ripple effects a stock market crash can have on society. Let's move on to Black Monday, the day the stock market experienced its largest one-day percentage drop. Picture it, October 19, 1987. The air is thick with anticipation, and then, like a thief in the night, the market plunges. This day would go down in history as Black Monday, a day of financial infamy. The crash was swift and brutal, with the Dow Jones Industrial Average dropping by an astounding 22.6%. This was the largest one-day percentage drop ever. The shockwaves rippled across the globe, with markets from Hong Kong to London feeling the pinch. What led to this catastrophic crash? The main culprits were program trading, overvaluation, and market psychology. Program trading, a strategy that involves the use of computer models to conduct large-scale trades automatically, played a significant role. It was like a domino effect. As stocks began to fall, these computer models kicked into high gear, selling off stocks at an unprecedented pace and leading to a downward spiral. Next, overvaluation. Prior to Black Monday, there had been a 5-year bull market. Stocks were riding high, but they were also incredibly overvalued. When this bubble burst, it led to a rush of sell-offs. Lastly, market psychology. Fear and panic spread like wildfire among investors. As the market began to tumble, this fear escalated, leading to a mass exodus from the stock market. It was a classic case of herd mentality, and it exacerbated the crash. In the aftermath of Black Monday, regulatory measures were put in place to prevent a similar occurrence. These included circuit breakers, which are temporary trading halts designed to curb panic selling. Black Monday showed us that even in modern times, markets are not immune to dramatic crashes. It was a stark reminder of the volatility inherent in the stock market and the importance of investor confidence. Crucially, it highlighted the need for safeguards to protect against such volatility. It was a painful lesson, but one that has shaped the way we approach investing today. Let's take a look at the turn of the century, where we saw the rise and fall of the dot-com bubble. As the 90s rolled in, a new era dawned, the internet age. The promise of a connected world and the allure of the digital frontier sparked a frenzy in the financial markets. Tech startups were sprouting like mushrooms after rain, and investors were all too eager to pour capital into these ventures, hoping to strike gold in the vast digital landscape. This period, known as the dot-com bubble, was characterized by excessive speculation and overvaluation of these internet-based companies. You see, many of these startups didn't even have a clear business model, let alone a profitable one. But that didn't matter. It was the internet, and everyone wanted a piece of it. The phrase "get big fast" was the mantra, and companies burned through cash at an astonishing rate in a race to gain market share. However, as the new millennium came around, reality began to set in. Profits were nowhere in sight for many of these ventures, and the once endless stream of investor money started to dry up. The tech-heavy Nasdaq Composite Index, which had soared to astronomical heights, began to plummet. The bubble had burst. In the early 2000s, the dot-com crash kicked into full gear. Companies folded left and right, their lofty stock prices crashing down to earth. Investors saw their fortunes evaporate overnight. The fallout was massive, with trillions of dollars in paper wealth wiped out. This crash was a stark reminder of the dangers of hype and overvaluation. It underscored the importance of sound financial fundamentals and the perils of irrational exuberance. While the allure of the next big thing can be tempting, the dot-com crash served as a sobering reminder that what goes up must come down. The dot-com crash was a clear reminder of the dangers of hype and overvaluation. Our journey brings us to a more recent crash, the 2008 financial crisis. This colossal meltdown, often deemed the worst economic disaster since the Great Depression of the 1930s, was a wake-up call to many. At the heart of the 2008 crisis were the banks, playing fast and loose with subprime mortgages. These were home loans given to individuals with poor credit scores, a risky move that was a ticking time bomb waiting to explode. When these borrowers started defaulting on their loans, it triggered a domino effect that tore through the financial world. But the banks weren't just handing out risky loans. They were bundling these subprime mortgages into complex financial products known as mortgage-backed securities. These were then sold off to investors around the world. When the housing market collapsed, these securities were left virtually worthless, causing massive losses for investors and institutions alike. The situation was further exacerbated by lax regulation. The financial watchdogs that were supposed to keep a check on the bank's activities were asleep at the wheel. This allowed banks to engage in risky practices with little to no oversight, a recipe for disaster. The stock market played a critical role in this crisis. As the truth of the bank's risky practices came to light, confidence in the market plummeted. Investors pulled out their money, leading to a massive sell-off. The Dow Jones Industrial Average, a key indicator of the stock market's health, experienced its worst point drop in history. The fallout was catastrophic. Millions of people lost their homes and jobs. Banks and financial institutions collapsed, and governments had to step in with massive bailouts to prevent a complete collapse of the financial system. The 2008 crash showed us the devastating effects of risky financial practices and lack of oversight. It served as a stark reminder that when greed and recklessness are allowed to run rampant in the financial world, it's the everyday people who pay the price. Finally, we come to the most recent crash, triggered by the global coronavirus pandemic. The year was 2020, and the world was caught in the grip of a global health crisis unlike any other in recent history. The novel coronavirus, or COVID-19 as it was officially known, had spread to every corner of the globe, wreaking havoc on health systems, economies, and everyday life. The stock market was not immune to this upheaval. In fact, the pandemic served as a catalyst that triggered a significant downturn in global financial markets. Within weeks, the world's leading stock markets had lost trillions of dollars in value, with major indices plunging to levels not seen since the financial crisis of 2008. But what were the factors that led to this crash? The primary driver was undoubtedly the global economic shutdown. As countries around the world went into lockdown to contain the spread of the virus, businesses were shuttered, travel came to a halt, and consumer spending plummeted. The result was a sudden and severe contraction in economic activity, leading to a sharp drop in corporate earnings, and consequently, stock prices. Adding to this was the unprecedented level of uncertainty. The virus was new, and its potential impact unknown. There were no precedents or models to guide investors. This uncertainty led to panic selling, further driving down stock prices. Central banks and governments around the world stepped in with massive stimulus measures to shore up economies and stabilize financial markets. But the damage was done. In the end, the coronavirus crash of 2020 was a seismic event that shook the global financial system to its core. It was a stark reminder of just how interconnected our world is, and how global events can have far-reaching impacts on our financial markets. The coronavirus crash is a stark reminder of the impact global events can have on our financial markets. As we've seen, stock market crashes are complex events with many contributing factors. They are not random occurrences, but rather the culmination of various elements that build up over time. They are the result of a combination of economic, financial, and sometimes social circumstances. Looking back to the South Sea Bubble in the early 18th century, we find a classic example of speculative frenzy. Investors were so enthralled by the prospect of vast wealth from overseas trade that they disregarded the fundamentals. The company's actual profits and the economy's ability to support such trade were overlooked. The bubble grew, and when reality finally dawned, the crash was inevitable. This teaches us the importance of maintaining a realistic perspective and not allowing excitement or fear to cloud our judgment. Then, there was the Great Depression, a devastating event that began with the stock market crash in 1929 and lasted a decade. It was a stark reminder of the domino effect a stock market crash can have on the wider economy. It taught us that unregulated markets can lead to excesses that have severe consequences when the bubble bursts. Fast forward to Black Monday in 1987, a day when panic selling led to a sharp fall in stock prices. Technology, specifically program trading, played a role in accelerating the decline. It was a wake-up call to the potential dangers of relying too heavily on automated systems without adequate safeguards. The dot-com bubble at the turn of the century was another lesson in the dangers of speculation and the importance of fundamentals. Companies with little to no profits were valued at astronomical levels, simply because they were in the tech space. When the bubble burst, it served as a reminder that a company's value should be based on its actual performance and potential profitability, not just hype and speculation. The 2008 financial crisis, triggered by the collapse of the subprime mortgage market in the United States, was a stark demonstration of how interconnected the global financial system is. It highlighted the need for better risk management and more prudent lending practices. Finally, the coronavirus crash of 2020 reminded us of the vulnerability of markets to unexpected global events. It showed us that diversification and resilience are key for survival in times of uncertainty. History teaches us that while crashes are a part of the financial cycle, understanding their causes can help us better navigate the future. Knowledge of the past can guide us in the present and help us build a more secure financial future. So let's learn from history and use these lessons to make more informed investment decisions.